Question 1. The monitoring system demonstrates a pattern of unusual transaction activity originating from a specific customer account at a small finance bank, which deviates significantly from their historical behavior and could potentially indicate a security breach or fraudulent activity. Option A. Ignore the alert, assuming it is a system glitch or a one-off anomaly, and continue with daily operations. Option B. Report the suspicious activity directly to the Reserve Bank of India without any internal review or escalation. Option C. Immediately escalate the alert to a small finance bank's designated compliance officer and the fraud detection unit for investigation and appropriate action. Option D. Attempt to contact the customer directly to inquire about the transactions without informing any internal departments. The correct answer is C. Immediately escalate the alert to a small finance bank's designated compliance officer and the fraud detection unit for investigation and appropriate action. Explanation. This scenario presents a professional challenge because it requires a small finance bank employee to interpret and act upon a potential breach of regulatory requirements without explicit, immediate guidance. The challenge lies in balancing the need for prompt action to mitigate risk with the imperative to adhere strictly to a small finance bank's internal policies and the regulatory framework governing small finance banks in India. Misinterpreting the situation or acting impulsively could lead to regulatory penalties, reputational damage for a small finance bank, and harm to customers. The correct approach involves a structured, risk-based decision-making process that prioritizes regulatory compliance and customer protection. This approach correctly identifies the need to escalate the issue to the designated compliance officer or department. This is justified by the Reserve Bank of India's (RBI) Guidelines and the Banking Regulation Act, 1949, which mandate robust internal controls and reporting mechanisms for identifying and addressing potential noncompliance. Specifically, the RBI's Master Direction on Internal Controls and the Master Direction on Outsourcing of IT Services, if applicable, would require a small finance bank to have clear procedures for handling such alerts, including immediate escalation to ensure timely investigation and remediation by those with the authority and expertise. An incorrect approach would be to ignore the alert, assuming it is a false positive. This fails to acknowledge the potential for a genuine breach and the regulatory obligation to investigate all suspicious activity. Such inaction could lead to significant penalties under the Banking Regulation Act, 1949, for failing to maintain adequate internal controls and risk management systems. Another incorrect approach would be to attempt to resolve the issue independently without consulting the compliance department. This bypasses established internal procedures and could lead to an inadequate or incorrect resolution, potentially exacerbating the problem or creating new compliance risks. This violates the principle of segregation of duties and the requirement for specialized knowledge in compliance matters, as mandated by RBI circulars on governance and risk management. A further incorrect approach would be to immediately report the issue externally to a regulatory body, without first following a small finance bank's internal escalation protocols. While transparency is important, premature external reporting can undermine internal investigation processes, create unnecessary alarm, and may not be the most efficient way to resolve the issue. Internal escalation ensures that a small finance bank can address the issue promptly and effectively, as expected by the RBI. Professionals should employ a decision-making framework that involves 1. Recognizing and understanding the potential risk or compliance issue. 2. Consulting internal policies and relevant regulatory guidelines. 3. Escalating the issue to the appropriate internal authority, e.g., compliance risk management. 4. Cooperating fully with the investigation and remediation efforts. 5. Documenting all actions taken. This systematic approach ensures that decisions are informed, compliant, and protect the interests of a small finance bank and its customers. Question 2. The performance metrics show a significant increase in a small finance bank's loan portfolio growth and a corresponding rise in net interest margins over the last 2 quarters. Which of the following approaches best addresses the potential risks associated with this trend, in line with regulatory expectations for a small finance bank? Option A. Implement a new, more stringent set of internal audit procedures across all departments without a specific link to the observed performance metrics. Option B. Assume the growth is sustainable and reflects improved market conditions, and focus on further expanding the loan book to capitalize on the current momentum. Option C. Conduct a detailed review of the credit appraisal process for all new loans originated during the period. Assess the adequacy of provisioning for potential non-performing assets and evaluate the bank's liquidity position in light of increased lending. Option D. Increase marketing efforts to attract more depositors to support the expanding loan portfolio, without a specific assessment of the credit quality of the existing or new loans. Correct answer is C. Conduct a detailed review of the credit appraisal process for all new loans originated during the period, assess the adequacy of provisioning for potential non-performing assets, and evaluate the bank's liquidity position in light of increased lending. Explanation. This scenario is professionally challenging because a small finance bank, like all regulated entities, must balance business growth with robust risk management. The performance metrics, while indicating positive trends, could mask underlying vulnerabilities. A failure to adequately assess and address these risks could lead to regulatory noncompliance, financial losses, and reputational damage. Careful judgment is required to interpret these metrics holistically, considering both their positive implications and potential risk exposures. The correct approach involves a comprehensive risk assessment that goes beyond surface-level performance indicators. This entails identifying potential risks associated with the observed performance, evaluating their likelihood and impact, and developing mitigation strategies. This aligns with the prudential regulatory framework governing small finance banks in India, which mandates a proactive and robust risk management system. Specifically, the Reserve Bank of India (RBI) guidelines emphasize the need for banks to have a strong risk governance framework, including regular identification, measurement, monitoring, and control of various risks such as credit risk, market risk, operational risk, and liquidity risk. By conducting a thorough risk assessment, a small finance bank demonstrates adherence to these regulatory expectations and a commitment to sound financial practices. An incorrect approach would be to solely focus on the positive performance metrics without considering the associated risks. For instance, attributing the performance solely to aggressive lending, without assessing the creditworthiness of new borrowers or the adequacy of provisioning, would be a significant regulatory and ethical failure. This overlooks the RBI's stringent guidelines on asset quality and provisioning norms, which are designed to protect depositors and the financial system. Another incorrect approach would be to implement risk mitigation measures that are superficial or not aligned with the identified risks. For example, implementing a generic compliance checklist without a tailored risk assessment for the specific business activities driving the performance metrics would be inadequate. This fails to meet the RBI's requirement for a risk-based approach to compliance and internal controls. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of the regulatory landscape and the bank's risk appetite. This involves critically evaluating performance data, identifying potential risk drivers, and then developing and implementing appropriate risk management strategies. The process should be iterative, with continuous monitoring and review to ensure the effectiveness of risk controls and compliance with regulatory requirements. Question 3. The risk matrix shows a moderate to high potential for operational and compliance risks associated with a small finance bank's proposed new digital lending product. The product aims to expand market reach and increase revenue. Which of the following approaches best aligns with regulatory expectations and sound risk management principles for a small finance bank? Option A. Proceed with the launch after a basic technical review, focusing on marketing and sales to capitalize on the revenue opportunity, with a plan to address any issues that arise post-launch. Option B. Delegate the entire risk assessment and mitigation process to the IT department, assuming they can manage all technical and operational aspects. Option C. Delay the launch indefinitely due to the identified risks, opting for a more conservative approach to product development. Option D. Conduct a comprehensive risk assessment involving all relevant departments, operations, compliance, legal, IT, and business. Develop detailed mitigation plans for identified risks and seek internal approvals before proceeding with the product launch. The correct answer is A. Proceed with the launch after a basic technical review, focusing on marketing and sales to capitalize on the revenue opportunity, with a plan to address any issues that arise post-launch. Explanation. This scenario is professionally challenging because it requires balancing the need for business growth with the imperative to adhere to regulatory requirements and ethical conduct. A small finance bank, like all regulated entities, must operate within the framework set by the Reserve Bank of India, RBI. The challenge lies in identifying and mitigating risks associated with new product launches, ensuring that customer interests are protected, and that the bank's operations remain sound and compliant. Careful judgment is required to assess the potential impact of the new digital lending product on various risk categories and to implement appropriate controls. The correct approach involves a comprehensive risk assessment and mitigation strategy that aligns with RBI guidelines for digital lending. This means thoroughly evaluating the product's potential impact on credit risk, operational risk, technology risk, compliance risk, and reputational risk. It requires developing robust internal controls, clear policies and procedures, and ensuring adequate training for staff. Specifically, adherence to the RBI's digital lending guidelines, which emphasize transparency, customer protection, and data privacy, is paramount. This approach ensures that a small finance bank can innovate responsibly, safeguarding both its customers and its own financial stability, while maintaining regulatory compliance. An incorrect approach that prioritizes immediate revenue generation without adequate risk assessment would be ethically and regulatorily unsound. This could lead to customer grievances, financial losses due to unforeseen issues, and potential penalties from the RBI for non-compliance with digital lending norms. Another incorrect approach, focusing solely on technical feasibility without considering the broader operational and compliance implications, would expose the bank to significant operational and regulatory risks. Failing to involve legal and compliance teams in the early stages of product development is a critical oversight that can lead to non-compliance with evolving regulations. Professionals should employ a structured decision-making framework that begins with understanding the regulatory landscape relevant to the proposed activity. This involves identifying all applicable laws, regulations, and guidelines, e.g., RBI's digital lending guidelines, master directions on IT risk management, etc. Next, a thorough risk assessment should be conducted, considering all potential risks and their likelihood and impact. Based on this assessment, mitigation strategies should be developed and implemented, including the establishment of clear policies, procedures, and controls. Finally, ongoing monitoring and review mechanisms should be put in place to ensure continued compliance and to adapt to any changes in the regulatory environment or risk profile. Question 4. The evaluation methodology shows that a small finance bank customer has lodged a complaint alleging that their personal financial data may have been compromised due to a system vulnerability. The customer has provided specific details about the perceived vulnerability. What is the most appropriate course of action for the small finance bank employee to take in accordance with the regulatory framework governing financial institutions in India? Option A. Immediately escalate the complaint to the bank's cybersecurity team for a detailed investigation and initiate the process for reporting to the Reserve Bank of India if the investigation confirms a data breach, while also informing the customer about the investigation's progress without disclosing sensitive details. Option B. Publicly announce that a potential data vulnerability has been identified and that the bank is investigating, without first confirming the breach or reporting to the regulator. Option C. Advise the customer that the bank's systems are secure and that no data breach has occurred, as there is no immediate evidence of compromise, and close the complaint. Option D. Ask the customer for more technical details about the vulnerability they observed, without initiating any internal investigation or reporting to the Reserve Bank of India to assess the credibility of their claim. The correct answer is A. Immediately escalate the complaint to the bank's cybersecurity team for a detailed investigation and initiate the process for reporting to the Reserve Bank of India if the investigation confirms a data breach, while also informing the customer about the investigation's progress without disclosing sensitive details. Explanation. This scenario presents a professional challenge for a small finance bank employee regarding the handling of customer complaints, specifically concerning potential data privacy breaches. The challenge lies in balancing the need for prompt complaint resolution with the stringent regulatory requirements of the Reserve Bank of India, RBI, and the Information Technology, IT Act 2000, particularly concerning data protection and reporting obligations. Careful judgment is required to ensure all regulatory mandates are met without compromising customer trust or operational efficiency. The correct approach involves acknowledging the complaint, initiating an internal investigation to ascertain the validity and scope of the alleged data breach, and reporting the incident to the RBI as per the stipulated guidelines for cybersecurity and data breach reporting. This aligns with the RBI's Master Direction on IT Governance, Risk, IT Examination, and Information Security, which mandates reporting of cyber incidents and data breaches. It also adheres to the principles of data protection under the IT Act, 2000, which requires entities to implement reasonable security practices and procedures. Prompt and transparent communication with the customer, while respecting the ongoing investigation, is also crucial. An incorrect approach would be to dismiss the complaint without a thorough investigation, citing a lack of immediate evidence. This fails to acknowledge the potential severity of a data breach and violates the proactive stance required by RBI regulations for cybersecurity incidents. Another incorrect approach would be to inform the customer about the specific details of the internal investigation before its completion or without proper authorization, which could compromise the investigation and potentially violate data privacy principles. Furthermore, failing to report the incident to the RBI within the prescribed timelines, even if the breach is confirmed, constitutes a significant regulatory noncompliance. Professionals should adopt a framework that prioritizes regulatory adherence and customer protection. This involves 1. Immediate acknowledgement of the customer's concern. 2. Activation of internal incident response protocols. 3. Assessment of the complaint against regulatory reporting thresholds. 4. Timely reporting to the relevant regulatory body, RBI in this case, if the assessment indicates a reportable incident. 5. Conducting a thorough investigation to understand the root cause and impact. 6. Communicating with the customer appropriately based on the investigation's findings and regulatory guidance. Question 5. Stakeholder feedback indicates that a customer has raised a concern regarding a potential data breach affecting their account with a small finance bank. As a representative of the bank, how should you respond to the stakeholder who is inquiring about the validity of this concern? Option A. State that a small finance bank cannot comment on specific customer account issues due to privacy policies. Option B. Directly confirm that a data breach has occurred and provide details about the extent of the compromised information. Option C. Promise the stakeholder that the issue will be resolved within 24 hours and that the customer will be compensated for any inconvenience. Option D. Acknowledge receipt of the feedback and inform the stakeholder that a small finance bank takes all customer concerns seriously and will review the matter internally according to established procedures. The correct answer is D. Acknowledge receipt of the feedback and inform the stakeholder that a small finance bank takes all customer concerns seriously and will review the matter internally according to established procedures. Explanation. This scenario presents a professional challenge because a small finance bank, like all regulated entities, must navigate the delicate balance between responding to customer concerns and adhering to strict data privacy and confidentiality regulations. The challenge lies in acknowledging feedback without inadvertently disclosing sensitive information or making commitments that could lead to regulatory breaches. Careful judgment is required to ensure that any communication is both responsive and compliant. The correct approach involves acknowledging the receipt of feedback and assuring the stakeholder that their concerns are being reviewed internally, without confirming or denying specific details of any ongoing investigation or customer interaction. This upholds the principle of confidentiality, as a small finance bank cannot discuss individual customer cases or internal processes publicly or with third parties unless legally mandated or with explicit customer consent. This aligns with the Reserve Bank of India's (RBI) guidelines on customer service and grievance redressal, which emphasize fair treatment and timely resolution while respecting privacy. An incorrect approach would be to directly confirm or deny the specific issue raised by the stakeholder. This could lead to a breach of customer confidentiality, violating the principles of the Banking Regulation Act, 1949, and RBI directives on customer service and data protection. Another incorrect approach would be to dismiss the feedback without any acknowledgement or commitment to review. This would fail to meet the expectations of fair treatment and responsiveness mandated by the RBI's customer service guidelines and could damage the bank's reputation. Finally, promising a specific outcome or timeline for resolution without a thorough internal review would be premature and could lead to unmet expectations and potential regulatory scrutiny if the bank fails to deliver. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the nature of the feedback and its potential implications. 2. Consulting internal policies and relevant regulatory guidelines, e.g., RBI circulars on customer service data privacy. 3. Formulating a response that is empathetic, acknowledges the feedback, and outlines a commitment to internal review without compromising confidentiality or making premature commitments. 4. Escalating complex or sensitive issues to appropriate internal departments for further guidance. Question 6. Risk assessment procedures indicate a potential for increased sales of a new investment product at a small finance bank, but your internal review suggests that a significant portion of potential customers may not fully understand the associated risks. A senior manager is strongly encouraging all staff to push this product aggressively to meet quarterly targets. You have a specific customer who is expressing interest but also significant confusion about the product's complexity. What is the most appropriate course of action? Option A. Politely decline to sell the product to this customer, citing their lack of understanding and move on to the next potential sale. Option B. Proceed with the sale, emphasizing the potential returns and downplaying the complexities to meet the sales target. Option C. Inform the customer that the product is highly recommended by management and that their confusion is likely due to a lack of financial literacy, encouraging them to sign quickly. Option D. Explain the product's risks and complexities clearly. Assess the customer's understanding, and if they still seem confused or hesitant, recommend alternative products that better suit their profile, even if it means not making the sale. The correct answer is B. Proceed with the sale, emphasizing the potential returns and downplaying the complexities to meet the sales target. Explanation. This scenario presents a professional challenge because it requires balancing the bank's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet targets can create a conflict of interest, potentially leading to decisions that compromise customer well-being or regulatory adherence. Careful judgment is required to navigate this conflict ethically and legally. The correct approach involves prioritizing customer best interests and regulatory compliance over short-term sales targets. This aligns with the fundamental principles of banking ethics and the regulatory framework governing a small finance bank. Specifically, it upholds the spirit of customer protection regulations, which mandate that financial institutions act in the best interests of their customers. By escalating the concern and seeking guidance, the employee demonstrates integrity and a commitment to responsible conduct, preventing potential harm to the customer and the bank. An incorrect approach that focuses solely on meeting the sales target without considering the customer's suitability or understanding would be a failure. This disregards the ethical duty of care and could violate regulations requiring fair treatment and suitability of financial products. Another incorrect approach, such as ignoring the customer's hesitation and proceeding with the sale, demonstrates a lack of integrity and a disregard for customer welfare, potentially leading to regulatory penalties and reputational damage for a small finance bank. Finally, an approach that involves pressuring the customer to accept the product, despite their reservations, is unethical and likely contravenes consumer protection laws. Professionals should employ a decision-making framework that begins with identifying potential ethical conflicts and regulatory breaches. This involves a thorough understanding of customer needs and the suitability of products. When faced with pressure to compromise these principles, the professional should seek clarification and guidance from supervisors or compliance departments. Escalating concerns and documenting all interactions are crucial steps in ensuring accountability and protecting both the customer and the institution. Question 7. The efficiency study reveals that a new customer relationship management (CRM) system could significantly streamline internal processes at a small finance bank by automating certain customer interaction logging. However, the proposed system's data handling protocols have not been fully vetted against the Reserve Bank of India's RBI guidelines on customer data privacy and consent management. Which of the following actions should a small finance bank employees prioritize in this situation? Option A. Implement the new CRM system but instruct customer-facing staff to manually override any data logging that might seem sensitive, relying on their discretion. Option B. Inform customers their new system is being implemented and that their data will be handled differently without providing specific details to manage expectations. Option C. Proceed with the implementation of the new CRM system immediately to realize the projected efficiency gains, assuming the system's developers have ensured compliance. Option D. Halt the implementation and conduct a thorough review of the new CRM system's data handling protocols to ensure full compliance with all applicable RBI regulations and to assess potential customer impact before proceeding. The correct answer is C. Proceed with the implementation of the new CRM system immediately to realize the projected efficiency gains, assuming the system's developers have ensured compliance. Explanation. This scenario presents a professional challenge for small finance bank employees by requiring them to navigate a situation where a perceived efficiency gain might conflict with regulatory obligations and ethical conduct. The core difficulty lies in balancing the bank's operational objectives with its duty to uphold customer trust and adhere to the Reserve Bank of India's (RBI) guidelines, particularly concerning customer data privacy and fair business practices. Careful judgment is required to ensure that any proposed changes do not inadvertently lead to non-compliance or customer detriment. The correct approach involves prioritizing regulatory compliance and customer welfare over immediate, unverified efficiency gains. This means thoroughly investigating the implications of the proposed system change, ensuring it aligns with all applicable RBI regulations, including those related to data security, customer consent, and grievance redressal. The bank must also conduct a risk assessment to identify potential negative impacts on customers and implement safeguards. This approach is professionally sound because it upholds the bank's legal and ethical responsibilities, fosters long-term customer loyalty, and protects the bank from regulatory penalties and reputational damage. Adherence to RBI guidelines, such as those outlined in the Master Direction Customer Service in Banks, is paramount. An incorrect approach that focuses solely on implementing the new system without adequate due diligence would fail to meet regulatory requirements. Specifically, bypassing a comprehensive review of the system's impact on customer data privacy would violate RBI directives on data protection and confidentiality. Similarly, an approach that prioritizes cost savings or perceived efficiency without considering the potential for customer inconvenience or miscommunication would contravene the spirit of fair business practices and customer service standards mandated by the RBI. Another incorrect approach might involve making assumptions about customer acceptance without seeking feedback or providing clear communication, which could lead to customer dissatisfaction and potential complaints, thereby failing to meet the bank's customer service obligations. Professionals should employ a decision-making framework that begins with identifying the core issue and its potential impact. This should be followed by a thorough review of relevant regulations and internal policies. Next, stakeholders should be consulted and a risk assessment conducted. Finally, the chosen course of action must be evaluated against regulatory requirements, ethical principles, and the bank's strategic objectives, ensuring that customer interests are always protected. Question 8. Compliance review shows that a customer of a small finance bank has lodged a complaint regarding a fraudulent transaction on their account. The customer is distressed and demands immediate reversal of the funds and compensation for their inconvenience. What is the most appropriate course of action for the small finance bank employee handling this complaint? Adhering strictly to the Reserve Bank of India's regulatory framework for grievance redressal and fraud management. Option A. Advise the customer that fraudulent transactions are not covered under the bank's standard complaint resolution policy and that they should pursue legal recourse independently. Option B. Acknowledge the complaint, initiate an internal investigation as per a small finance bank's fraud reporting policy, and inform the customer about the investigation process and expected timelines for resolution, including escalation procedures. Option C. Immediately reverse the funds and offer compensation to the customer to resolve the complaint quickly and maintain customer satisfaction. Option D. Promise the customer that the funds will be reversed and compensation will be provided once a preliminary review confirms the transaction appears suspicious, without initiating a formal investigation. The correct answer is C. Immediately reverse the funds and offer compensation to the customer to resolve the complaint quickly and maintain customer satisfaction. Explanation. This scenario presents a professional challenge for small finance bank employees due to the inherent conflict between customer service expectations and regulatory compliance requirements. Employees must exercise careful judgment to balance the need to provide prompt and satisfactory service with the imperative to adhere strictly to the Reserve Bank of India's (RBI) guidelines on customer grievance redressal. Misinterpreting or overlooking these guidelines can lead to regulatory penalties, reputational damage, and a decline in customer trust. The correct approach involves a thorough understanding and application of the RBI's Master Direction Reserve Bank of India, Frauds, Repository, 2016, and subsequent circulars pertaining to customer grievance redressal mechanisms. Specifically, it requires acknowledging the customer's complaint, initiating the internal investigation process as mandated, and providing the customer with a clear timeline for resolution, including escalation procedures if the initial resolution is unsatisfactory. This adheres to the principle of fair treatment of customers and ensures that a small finance bank operates within the regulatory framework designed to protect depositors and maintain financial system integrity. An incorrect approach that prioritizes immediate customer appeasement without following the prescribed grievance redressal process fails to uphold regulatory obligations. This could involve making promises of immediate compensation or resolution without proper investigation, which contravenes the RBI's directives on fair practices and may lead to incorrect or premature decisions. Another incorrect approach, such as dismissing the complaint outright without a formal review, demonstrates a lack of due diligence and a disregard for the customer's rights, potentially violating the spirit and letter of the RBI's customer protection guidelines. Furthermore, delaying the formal acknowledgement or investigation process beyond stipulated timelines, even with the intention of gathering more information, can be construed as a failure to adhere to the mandated grievance redressal timelines, exposing a small finance bank to regulatory scrutiny. Professionals at a small finance bank should employ a decision-making framework that begins with identifying the nature of the customer's concern and cross-referencing it with the RBI's established grievance redressal procedures. This involves understanding the internal escalation matrix and the timelines associated with each stage of the complaint resolution process. When faced with a customer complaint, the immediate step should be to formally log and acknowledge the complaint, followed by initiating the investigation as per internal policy, which is aligned with RBI guidelines. If the situation requires a deviation or a more complex resolution, it should be handled through the designated channels and within the prescribed timelines, ensuring transparency and fairness to the customer. Question 9. The efficiency study reveals that a new data analytics tool could significantly streamline customer onboarding at a small finance bank by processing a wider range of customer information. However, the implementation of this tool would involve sharing anonymized customer data with a third-party vendor for processing. Which of the following represents the most appropriate course of action for a small finance bank's compliance team? Option A. Conduct a comprehensive review of a small finance bank's data privacy policies and relevant Indian regulations, including the Digital Personal Data Protection Act, 2023, to assess the legality and ethical implications of sharing anonymized data with a third-party vendor and seek necessary approvals. Option B. Inform the affected customers about the potential use of their anonymized data for efficiency improvements and proceed with implementation if no objections are received. Option C. Proceed with the implementation of the data analytics tool after ensuring the third-party vendor has a standard non-disclosure agreement in place. Option D. Implement the tool immediately, assuming that anonymized data poses no significant privacy risks and that existing general data handling policies are sufficient. The correct answer is C. Proceed with the implementation of the data analytics tool after ensuring the third-party vendor has a standard non-disclosure agreement in place. Explanation. This scenario presents a professional challenge for small finance bank employees regarding the handling of customer data and the potential for conflicts of interest, particularly when an efficiency study highlights opportunities for process improvement that could inadvertently expose sensitive information. The need for careful judgment stems from the dual responsibility of enhancing operational efficiency and upholding stringent data privacy regulations. The correct approach involves a thorough review of a small finance bank's internal policies and relevant Indian regulatory frameworks, such as the Reserve Bank of India, RBI, guidelines on data protection and customer confidentiality, and potentially the Digital Personal Data Protection Act, 2023, if applicable to the specific data being handled. This approach prioritizes compliance by ensuring that any proposed efficiency improvements are vetted against these regulations. Specifically, it requires identifying if the proposed changes involve sharing customer data with third parties, how that data will be anonymized or pseudonymized, and if customer consent is required. The regulatory justification lies in adhering to the spirit and letter of data protection laws, which are designed to safeguard customer trust and prevent financial and reputational damage arising from data breaches or misuse. Ethical considerations also mandate that employees act in the best interest of the customer, which includes protecting their personal and financial information. An incorrect approach would be to immediately implement the efficiency recommendations without a formal compliance review. This failure stems from a disregard for regulatory obligations, potentially violating provisions related to data privacy and customer confidentiality mandated by the RBI and other relevant Indian laws. Such an action could lead to significant penalties, legal action, and severe damage to a small finance bank's reputation. Another incorrect approach would be to proceed with implementation by assuming existing policies are sufficient without a specific review for the new efficiency measures. This demonstrates a lack of due diligence and a failure to proactively identify and mitigate new risks introduced by the proposed changes, which is a breach of professional responsibility and regulatory expectation for continuous compliance monitoring. Professionals should adopt a decision-making framework that begins with understanding the regulatory landscape relevant to a small finance bank's operations. When faced with proposals that impact customer data or processes, the immediate step should be to consult internal compliance departments and relevant regulatory guidelines. A risk assessment should be conducted, focusing on potential data privacy violations, security vulnerabilities, and ethical implications. Any proposed changes must then be evaluated against this risk assessment and the regulatory framework before implementation. This proactive and compliance-first mindset ensures that efficiency gains do not come at the cost of regulatory adherence and customer trust. Question 10. Quality control measures reveal that a customer of a small finance bank has lodged a complaint alleging that a loan officer provided information about a new savings product that was misleading regarding its interest rate calculation, potentially contravening the Reserve Bank of India's guidelines on fair disclosure of financial products. Which of the following approaches best aligns with a small finance bank's regulatory obligations? Option A. Inform the customer that the bank cannot address complaints related to potential regulatory breaches and suggest they contact the Reserve Bank of India directly. Option B. Document the complaint internally but take no further action unless the customer formally requests a regulatory inquiry. Option C. Advise the customer that the information provided was likely a misunderstanding of the product's features and attempt to resolve it through standard customer service channels. Option D. Immediately escalate the complaint to the bank's compliance department for a formal review and potential investigation into the loan officer's conduct and adherence to RBI guidelines. The correct answer is C. Advise the customer that the information provided was likely a misunderstanding of the product's features and attempt to resolve it through standard customer service channels. Explanation. Scenario analysis. This scenario presents a professional challenge for a small finance bank employees regarding the handling of customer complaints, specifically when a complaint involves potential regulatory breaches. The challenge lies in balancing the need for efficient complaint resolution with the imperative of adhering to strict regulatory reporting requirements. Misinterpreting or mishandling such a complaint can lead to significant reputational damage, regulatory penalties, and a loss of customer trust. The professional judgment required involves accurately identifying the nature of the complaint and its potential regulatory implications, ensuring that the bank's internal processes are robust enough to capture and escalate such issues appropriately. Correct approach analysis. The correct approach involves meticulously documenting the complaint, identifying any elements that suggest a breach of regulations applicable to a small finance bank, and escalating it through the bank's established internal channels for regulatory reporting and investigation. This aligns with the principles of regulatory compliance and good corporate governance. A small finance bank, as a regulated entity, is obligated to have robust systems for identifying, reporting, and addressing potential regulatory noncompliance. This approach ensures that the bank fulfills its statutory duties, maintains transparency with regulatory bodies, and takes proactive steps to rectify any issues, thereby protecting both the bank and its customers. Incorrect approach is analysis, dismissing the complaint without thorough investigation, based on the customer's perceived lack of technical understanding, is a significant regulatory and ethical failure. It demonstrates a disregard for customer grievances and a failure to identify potential systemic issues that could have regulatory consequences. This approach risks the bank overlooking a genuine breach, leading to potential penalties and reputational damage. Attempting to resolve the complaint solely through customer service channels without considering the potential regulatory implications is also an incorrect approach. While customer service is important, it should not supersede the bank's obligation to comply with regulatory frameworks. If a complaint hints at a regulatory breach, it requires a more formal and structured response that involves compliance and legal departments. Ignoring the complaint altogether due to its complexity or the perceived difficulty in resolving it is a dereliction of duty. A small finance bank has a responsibility to address all customer complaints in a timely and appropriate manner, especially those that may involve regulatory breaches. This inaction can be interpreted as willful ignorance and can lead to severe regulatory scrutiny. Professional reasoning. Professionals at a small finance bank should adopt a framework that prioritizes regulatory adherence and customer welfare. This involves 1. Active listening and documentation, thoroughly understanding and recording all aspects of the customer's complaint. 2. Risk identification, assessing whether the complaint on its face suggests a violation of any applicable laws, regulations, or internal policies. 3. Escalation protocol, following established internal procedures for escalating complaints that indicate potential regulatory breaches to the appropriate departments, e.g., compliance, risk management, legal. 4. Investigation and resolution, cooperating fully with internal investigations and ensuring that any identified issues are rectified in accordance with regulatory requirements. 5. Continuous improvement, using complaint data to identify trends and improve internal processes and controls to prevent future occurrences. Question 11. Strategic planning requires a small finance bank employees to maintain the highest standards of integrity. If an employee of a small finance bank becomes aware of a significant upcoming strategic decision that is not yet public and is likely to materially affect the stock price of a particular listed company, what is the most ethical and legally compliant course of action? Option A. Share the information with a close friend who is an active investor, suggesting they might find it interesting. Option B. Discreetly purchase shares of the company before the information becomes public, believing it is a personal opportunity. Option C. Immediately refrain from trading in the securities of that company and ensure no disclosure of the information to any third party. Option D. Wait for the information to be officially announced and then make investment decisions based on the public announcement. The correct answer is C. Immediately refrain from trading in the securities of that company and ensure no disclosure of the information to any third party. Explanation. This scenario presents a professional challenge for an employee at a small finance bank due to the inherent conflict between personal gain and the bank's ethical obligations and regulatory compliance. The employee's knowledge of an upcoming strategic decision that could impact a specific company's stock price creates a situation where insider trading, or the appearance of it, is a significant risk. A small finance bank, as a regulated entity, must uphold the highest standards of integrity and fair dealing to maintain public trust and comply with the Reserve Bank of India's (RBI) guidelines and SEBI, Securities and Exchange Board of India, regulations concerning market conduct and insider trading. The correct approach involves prioritizing ethical conduct and regulatory compliance above personal benefit. This means refraining from any action that could be construed as leveraging confidential information for personal gain. Specifically, the employee must not trade in the securities of the company in question, nor should they disclose this information to any third party who might trade on it. This aligns with the principles of fair markets and prevents market manipulation, which are core tenets of financial regulation in India. The employee's duty of confidentiality and loyalty to a small finance bank is paramount. An incorrect approach would be to proceed with trading based on the confidential information. This directly violates SEBI prohibition of insider trading regulations, which strictly prohibit individuals in possession of unpublished price-sensitive information, UPSI, from trading in securities. Such an action would not only lead to severe penalties for the individual, including fines and potential imprisonment, but also damage the reputation of a small finance bank. Another incorrect approach would be to subtly hint at the upcoming information to a friend or family member without explicitly stating it. This is still a form of tipping and can be considered insider trading, as it facilitates the misuse of UPSI. The intent to profit from non-public information, even indirectly, is unethical and illegal. Professionals in similar situations should employ a robust decision-making framework that prioritizes ethical considerations and regulatory adherence. This involves 1. Identifying the confidential nature of the information. 2. Recognizing the potential for misuse and its regulatory implications. 3. Consulting internal policies and compliance officers if unsure. 4. Prioritizing the bank's integrity and regulatory obligations over personal interests. 5. Taking no action that could be perceived as a breach of trust or a violation of securities laws. Question 12. Benchmark analysis indicates that an employee at a small finance bank is aware that a loan application has been submitted by a close personal friend. The employee has no direct involvement in the loan processing or approval stages, but is aware of the application's existence. What is the most appropriate course of action for this employee to ensure compliance with a small finance bank's ethical guidelines and relevant banking regulations? Option A. Disclose the personal relationship to their immediate supervisor or the designated compliance officer within a small finance bank. Option B. Discreetly inquire about the status of the loan application from colleagues involved in processing to ensure it is being handled favorably. Option C. Proceed with their duties, assuming no conflict of interest exists as they are not directly involved in the loan decision. Option D. Advise the friend on how to strengthen their loan application without revealing the personal connection to bank officials. The correct answer is A. Disclose the personal relationship to their immediate supervisor or the designated compliance officer within a small finance bank. Explanation. This scenario presents a professional challenge for a small finance bank employee by requiring them to navigate the ethical and regulatory implications of a potential conflict of interest. The challenge lies in balancing the bank's commitment to fair lending practices and customer trust with the personal relationships of its employees. Careful judgment is required to ensure that personal connections do not unduly influence lending decisions, thereby upholding the integrity of the bank's operations and adhering to regulatory expectations. The correct approach involves a transparent disclosure of the personal relationship to the relevant authority within a small finance bank. This aligns with the principles of good corporate governance and regulatory compliance, specifically the guidelines set forth by the Reserve Bank of India, RBI, concerning conduct and ethical practices in banking. By disclosing the relationship, the employee ensures that the loan application can be assessed objectively, free from any perceived or actual bias. This proactive step safeguards the bank from potential reputational damage and regulatory scrutiny, reinforcing its commitment to fair and impartial service delivery. An incorrect approach would be to proceed with the loan assessment without disclosure. This failure constitutes a breach of ethical conduct and potentially violates RBI guidelines on conflicts of interest. Such an action could lead to accusations of favoritism, undermining customer confidence and the bank's reputation for fairness. Another incorrect approach would be to subtly influence the decision-making process in favor of the acquaintance, even without explicit disclosure. This is a direct contravention of the principle of objective assessment and could result in the approval of a loan that does not meet the bank's credit risk criteria, exposing a small finance bank to financial losses and regulatory penalties. Finally, attempting to conceal the relationship by delegating the assessment to a colleague without informing them of the personal connection is also an unacceptable approach. This deception not only violates ethical standards, but also prevents the colleague from being aware of a potential bias, thereby compromising the integrity of their professional judgment. Professionals should adopt a decision-making framework that prioritizes transparency, ethical conduct, and regulatory adherence. When faced with a potential conflict of interest, the immediate step should be to identify the conflict, and then to disclose it to the appropriate internal channels as per a small finance bank's internal policies and relevant RBI directives. This ensures that the situation is managed appropriately and that decisions are made in the best interest of the bank and its customers. Question 13. Stakeholder feedback indicates that some customers of a small finance bank are requesting to receive sensitive account information, such as transaction summaries or account balance details, via unsecured communication channels like personal email or SMS, citing convenience. As an employee of a small finance bank, what is the most appropriate course of action to balance customer convenience with regulatory compliance? Option A. Attempt to find a workaround to send the information through the unsecured channel, perhaps by encrypting it with a password shared separately, to meet the customer's request. Option B. Politely explain that for security reasons and to comply with banking regulations, sensitive account information cannot be shared via unsecured channels, and offer to provide the information through secure, verified channels or in person. Option C. Immediately provide the requested account information via the customer's preferred unsecured channel to ensure customer satisfaction and convenience. Option D. Dismiss the customer's request outright, stating that such information is never shared externally, without offering any alternative solutions. The correct answer is B. Politely explain that for security reasons and to comply with banking regulations, sensitive account information cannot be shared via unsecured channels, and offer to provide the information through secure, verified channels or in person. Explanation. This scenario presents a professional challenge for a small finance bank employees due to the inherent tension between customer service expectations and the regulatory requirements governing data privacy and security. Employees must exercise careful judgment to balance the need for efficient customer interaction with the imperative to protect sensitive information, as mandated by Indian banking regulations. The correct approach involves a measured response that acknowledges the customer's request while clearly and politely explaining the bank's policy and the underlying regulatory reasons for it. This demonstrates respect for the customer's needs while upholding compliance. Specifically, a small finance bank operating under the Reserve Bank of India's RBI guidelines must adhere to principles of data confidentiality and secure handling of customer information. Providing sensitive details over an unsecured channel or without proper verification would contravene these regulations, potentially leading to data breaches, identity theft, and significant reputational damage for the bank. Ethical considerations also dictate a duty of care to protect customer data. An incorrect approach that immediately provides the requested information without verification fails to uphold the bank's duty of care and violates data protection principles. This could expose the customer to fraud and the bank to regulatory penalties. Another incorrect approach, which is overly dismissive or unhelpful, damages customer relationships and may not adequately explain the rationale behind the bank's policy, leading to customer dissatisfaction and potential complaints. A third incorrect approach that attempts to bypass security protocols, even with good intentions, is a direct violation of internal policies and regulatory mandates, creating significant compliance risks. Professionals at a small finance bank should employ a decision-making framework that prioritizes regulatory compliance and customer data security. This involves 1. Listening to the customer's request and understanding their need. 2. Assessing the request against internal policies and relevant RBI guidelines. 3. If the request cannot be immediately fulfilled due to security or policy constraints, clearly and respectfully explaining the limitations and the reasons behind them. 4. Offering alternative compliant methods to assist the customer. 5. Documenting the interaction and the resolution. Question 14. Upon reviewing a request from a colleague in another department at a small finance bank for specific customer transaction details to assist with a potential fraud investigation, what is the most appropriate course of action to ensure compliance with banking regulations and internal policies? Option A. Forward the request to the bank's designated fraud investigation unit or compliance department for review and authorized action, ensuring all internal protocols are followed. Option B. Immediately provide the requested transaction details to the colleague, as they are from within the bank, and the purpose is stated as fraud investigation. Option C. Inform the colleague that you cannot provide any customer information due to strict privacy rules without suggesting an alternative process. Option D. Promise to look into the request later when you have more time, without specifying a time frame or confirming the legitimacy of the request. The correct answer is B. Immediately provide the requested transaction details to the colleague, as they are from within the bank, and the purpose is stated as fraud investigation. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for information with the strict regulatory obligations of a small finance bank regarding customer data privacy and confidentiality. The bank's employees are entrusted with sensitive customer information, and any unauthorized disclosure or misuse can lead to severe regulatory penalties, reputational damage, and loss of customer trust. The core of the challenge lies in discerning legitimate business needs from requests that could potentially breach privacy regulations. The correct approach involves adhering strictly to a small finance bank's internal policies and relevant Indian banking regulations, such as those stipulated by the Reserve Bank of India, RBI. This approach prioritizes data protection by ensuring that any request for customer information is channeled through established, secure, and authorized procedures. It mandates verification of the requester's identity and authority, confirmation of a legitimate business purpose, and adherence to the principle of data minimization, only accessing or sharing information that is strictly necessary. This aligns with the RBI's guidelines on customer service, data security, and privacy, which emphasize the need for robust internal controls and a customer-centric approach that respects confidentiality. An incorrect approach that involves directly providing the requested information without proper verification or authorization is fundamentally flawed. This action would constitute a breach of customer confidentiality and potentially violate the Banking Regulation Act, 1949, and RBI directives on data privacy and security. Such a breach could result in significant fines, regulatory sanctions, and legal action against a small finance bank. Another incorrect approach, which is to ignore the request entirely, is also professionally unacceptable. It avoids a direct breach, it fails to address a potential legitimate business need, and could lead to operational inefficiencies or missed opportunities if the request was indeed valid and authorized. It also demonstrates a lack of proactive problem solving and adherence to service standards expected of small finance bank employees. A third incorrect approach, which is to vaguely promise to look into it without a concrete plan or timeline, is insufficient. This approach lacks the decisiveness and commitment required to handle such requests effectively and ethically. It creates ambiguity and can lead to delays, potentially frustrating both the requester and internal stakeholders, and still carries the risk of non-compliance if not followed up rigorously. The professional decision-making process for such situations should involve a clear framework. 1. Understand the request. Fully comprehend what information is being asked for and by whom. 2. Identify the requester's authority. Verify the identity and legitimate authority of the person making the request. 3. Determine the business need. Ascertain the specific legitimate business purpose for which the information is required. 4. Consult internal policies and regulations. Refer to a small finance bank's internal data access and privacy policies, as well as applicable RBI guidelines. 5. Follow authorized channels. If the request appears legitimate, direct it through the bank's established, secure, and authorized channels for information dissemination. 6. Document everything. Maintain a clear record of the request, the verification process, the decision made, and the action taken. 7. Escalate if necessary. If there is any doubt or ambiguity, escalate the request to a supervisor or the relevant compliance department. Question 15. Strategic planning requires a small finance bank to consider the potential ramifications of its expansion initiatives. Which of the following approaches best ensures that growth objectives are pursued in a manner that upholds regulatory compliance and sound risk management principles? Option A. Implementing new initiatives rapidly to gain a first-mover advantage, deferring detailed risk and compliance reviews until after market entry. Option B. Focusing primarily on achieving ambitious growth targets with minimal consideration for the operational and regulatory complexities involved. Option C. Prioritizing aggressive market expansion and revenue generation, addressing compliance and risk issues only as they emerge. Option D. Conducting a comprehensive impact assessment that evaluates potential regulatory, risk, and customer consequences before implementing new strategies. The correct answer is D. Conducting a comprehensive impact assessment that evaluates potential regulatory, risk, and customer consequences before implementing new strategies. Explanation: scenario analysis. This scenario presents a common challenge in the financial services sector, particularly for a small finance bank like a small finance bank. The challenge lies in balancing the need for rapid growth and market penetration with the imperative to adhere strictly to regulatory requirements and maintain robust risk management practices. The pressure to achieve ambitious targets can sometimes lead to shortcuts or overlooking potential risks, which can have severe consequences, including regulatory penalties, reputational damage, and financial losses. Therefore, a careful and informed judgment is required to ensure that strategic decisions are both growth-oriented and compliant. Correct approach analysis. The correct approach involves a comprehensive impact assessment that systematically evaluates the potential consequences of strategic initiatives on various aspects of a small finance bank's operations, including its compliance framework, risk profile, and customer impact. This assessment should involve cross-functional teams, including risk management, compliance, operations, and business development. By proactively identifying potential risks and compliance gaps, a small finance bank can develop mitigation strategies before implementation, ensuring that growth plans are sustainable and aligned with regulatory expectations. This aligns with the principles of sound risk management and regulatory compliance mandated by the Reserve Bank of India, RBI, for small finance banks, emphasizing a proactive and integrated approach to business strategy and risk oversight. Incorrect approaches analysis. Focusing solely on aggressive market expansion without a thorough understanding of the regulatory implications is a significant failure. This approach risks violating prudential norms, customer protection guidelines, and anti-money laundering (AML) regulations, potentially leading to penalties from the RBI. Prioritizing short-term revenue gains over long-term compliance and risk management is ethically unsound and professionally irresponsible. Adopting a reactive approach, where compliance and risk issues are addressed only after they arise, is also a critical failure. This demonstrates a lack of foresight and a disregard for the preventative measures expected of regulated entities. Such a reactive stance can lead to escalating problems, greater remediation costs, and a damaged reputation, undermining the bank's credibility and stability. Ignoring potential customer impact in the pursuit of growth is another failure. A small finance bank, as a small finance bank, has a mandate to serve specific customer segments. Any strategic initiative that negatively impacts these customers, such as through opaque product offerings or inadequate grievance redressal, would contravene customer protection principles and could lead to significant reputational and regulatory repercussions. Professional reasoning. Professionals at a small finance bank should adopt a decision-making framework that integrates strategic planning with robust risk and compliance management. This involves 1. Proactive risk identification, continuously scanning the internal and external environment for potential risks associated with new strategies. 2. Regulatory due diligence, thoroughly understanding and applying all relevant RBI guidelines, circulars, and prudential norms. 3. Impact assessment, quantifying and qualifying the potential impact of strategic decisions on all stakeholders, including customers, employees, and the bank's financial health. 4. Mitigation planning, developing concrete plans to address identified risks and compliance gaps before implementation. 5. Continuous monitoring and review, regularly assessing the effectiveness of implemented strategies and making necessary adjustments. This structured approach ensures that growth is pursued responsibly and sustainably, safeguarding the bank's integrity and its commitment to regulatory compliance. Question 16. The efficiency study reveals that consolidating customer data across various or small finance bank departments could significantly reduce operational costs and improve service delivery speed. However, this consolidation would involve accessing and processing a wider range of sensitive personal and financial information. Considering the regulatory landscape for financial institutions in India, which approach best balances efficiency gains with compliance and customer protection? Option A. Defer any data consolidation efforts indefinitely due to the perceived complexity of regulatory compliance, focusing solely on existing operational processes. Option B. Conduct a thorough review of all applicable RBI guidelines and Indian data protection laws, perform a comprehensive data privacy and security risk assessment, and develop a phased consolidation plan with robust anonymization and consent mechanisms before implementation. Option C. Proceed with immediate data consolidation, implementing basic security measures, and addressing any compliance issues that arise post-implementation. Option D. Prioritize cost reduction by consolidating data without extensive privacy impact assessments, assuming that existing general data security protocols are sufficient. The correct answer is C. Proceed with immediate data consolidation, implementing basic security measures, and addressing any compliance issues that arise post-implementation. Explanation. This scenario presents a professional challenge for small finance bank employees by requiring them to balance operational efficiency with regulatory compliance and customer data protection. The core tension lies in the potential for cost savings through data consolidation versus the stringent requirements of data privacy regulations applicable to financial institutions in India. A small finance bank, as a regulated entity, must adhere to the Reserve Bank of India, RBI, guidelines and relevant Indian data protection laws. The correct approach involves prioritizing regulatory compliance and customer data security above immediate cost-saving measures. This means implementing data consolidation strategies only after thorough risk assessments, ensuring robust data anonymization or pseudonymization techniques are in place, and obtaining necessary customer consents where applicable, all in strict accordance with RBI directives on data handling and privacy. This approach upholds the bank's legal obligations and maintains customer trust, which is paramount for a financial institution. An incorrect approach would be to proceed with aggressive data consolidation without adequate safeguards, potentially leading to breaches of customer confidentiality. This directly violates the principles of data privacy mandated by Indian law and RBI guidelines, which emphasize secure data storage, limited access, and the protection of sensitive customer information. Another incorrect approach would be to ignore the efficiency study's findings entirely, failing to explore legitimate avenues for operational improvement that could benefit the bank and its customers, thereby missing opportunities for responsible innovation within the regulatory framework. Finally, an approach that prioritizes cost savings without considering the ethical implications of data handling or the potential for regulatory penalties would be professionally unsound and detrimental to the bank's reputation. Professionals at a small finance bank should employ a decision-making framework that begins with identifying all relevant regulatory obligations, RBI, IT Act, etc. This should be followed by a comprehensive risk assessment of any proposed operational change, considering data privacy, security, and potential legal ramifications. Subsequently, they should explore solutions that align with both efficiency goals and regulatory requirements, seeking expert legal and compliance advice where necessary. The ultimate decision must be one that demonstrably protects customer data and adheres to all applicable laws and guidelines. Question 17. Examination of the data shows that a small finance bank is considering a new initiative to analyze customer transaction patterns to identify potential cross-selling opportunities for new financial products. The proposed analytical process involves accessing and reviewing detailed customer transaction histories, including names, account numbers, and specific transaction amounts and dates. What is the most compliant approach for a small finance bank to undertake this analysis? Option A. Proceed with the analysis using the raw, identifiable customer data, as this provides the most granular insights for effective cross-selling. Option B. Rely on the bank's existing internal data usage policy, which permits analysis of customer data for business development purposes without specific anonymization requirements. Option C. Implement robust anonymization or pseudonymization techniques on the customer transaction data before conducting the analysis, ensuring individual identities are protected. Option D. Obtain explicit, informed consent from every customer whose transaction data will be analyzed, detailing the exact purpose and scope of the analysis. The correct answer is A. Proceed with the analysis using the raw, identifiable customer data, as this provides the most granular insights for effective cross-selling. Explanation. This scenario presents a professional challenge because a small finance bank, like all regulated entities, must adhere strictly to the Reserve Bank of India's, RBI, guidelines regarding customer data privacy and security. The challenge lies in balancing the bank's operational needs for data analysis with its legal and ethical obligations to protect sensitive customer information. A misstep can lead to severe regulatory penalties, reputational damage, and loss of customer trust. The correct approach involves anonymizing or pseudonymizing customer data before it is used for analytical purposes, ensuring that individual identities cannot be reasonably ascertained. This aligns with the principles of data minimization and purpose limitation, enshrined in relevant Indian data protection frameworks and RBI circulars. By removing or obscuring direct identifiers, a small finance bank upholds its commitment to customer privacy while still enabling valuable business insights. An incorrect approach would be to use raw, identifiable customer data for analysis without explicit consent or robust anonymization. This directly violates data protection principles and could expose the bank to significant legal repercussions under Indian law, including potential penalties for data breaches and non-compliance with RBI directives on data security and customer confidentiality. Another incorrect approach would be to rely solely on internal policies that are not aligned with or are weaker than regulatory requirements. While internal policies are important, they cannot supersede statutory obligations. Failure to implement measures that meet or exceed regulatory standards, even if permitted by a less stringent internal policy, is a regulatory failure. Finally, an approach that prioritizes business analytics over data security, even with the intention of improving services, is ethically unsound and legally risky. The professional decision-making process should always begin with a thorough understanding of the applicable regulatory landscape, particularly RBI guidelines on data handling. This should be followed by a risk assessment to identify potential privacy vulnerabilities and the implementation of appropriate safeguards, such as anonymization techniques, before any data is processed for analytical purposes. Transparency with customers about data usage, where applicable and legally permissible, is also a key component of ethical data handling. Question 18. Assessment of process optimization initiatives at a small finance bank, which aims to enhance customer onboarding efficiency, requires a thorough understanding of the regulatory framework. Which of the following approaches best aligns with the operational and compliance expectations for a small finance bank in India? Option A. Outsourcing the entire onboarding process to a third-party vendor without conducting a comprehensive due diligence on their data security protocols and regulatory adherence. Option B. Implementing a fully automated digital onboarding system that reduces manual intervention and processing time, ensuring all data capture and verification steps are compliant with RBI's Know Your Customer (KIC) and anti-money laundering (AML) guidelines. Option C. Reducing the number of mandatory data fields collected during onboarding to expedite the process, assuming that any missing information can be requested later from the customer. Option D. Introducing a simplified, paperless onboarding process that prioritizes speed and customer convenience, with a plan to address regulatory compliance issues retrospectively if they arise. The correct answer is B. Implementing a fully automated digital onboarding system that reduces manual intervention and processing time, ensuring all data capture and verification steps are compliant with RBI's Know Your Customer (KIC) and anti-money laundering (AML) guidelines. Explanation. This scenario presents a professional challenge for small finance bank employees tasked with optimizing internal processes. The core difficulty lies in balancing the need for efficiency and innovation with the stringent regulatory requirements governing financial institutions in India. A small finance bank operates under the purview of the Reserve Bank of India, RBI, which mandates specific guidelines for operational conduct, data security, and customer service. Any process optimization initiative must demonstrably adhere to these regulations, ensuring customer data protection, fair practices, and systemic stability. Hasty or poorly considered optimization can lead to regulatory breaches, reputational damage, and financial penalties. The correct approach involves a comprehensive review of existing processes, identifying bottlenecks and inefficiencies, and then proposing solutions that are not only effective, but also fully compliant with RBI guidelines. This includes thorough risk assessments, impact analyses on customer service and data privacy, and obtaining necessary internal and potentially external approvals before implementation. This approach ensures that a small finance bank maintains its license to operate and upholds public trust by prioritizing regulatory adherence and customer well-being alongside operational improvements. An incorrect approach that focuses solely on cost reduction without considering regulatory implications would be professionally unacceptable. For instance, implementing a new digital platform without adequate data encryption or customer consent mechanisms would violate RBI's data protection directives and potentially the IT framework for banks. Similarly, streamlining customer service by reducing human interaction points without providing accessible alternative channels or clear escalation paths could contravene RBI's customer service guidelines, leading to customer dissatisfaction and regulatory scrutiny. Another flawed approach might involve adopting new technologies without proper vendor due diligence, risking data breaches or operational disruptions that could have regulatory consequences. Professionals at a small finance bank should employ a structured decision-making process that begins with a clear understanding of the current regulatory landscape as defined by the RBI. This involves identifying all applicable laws, circulars, and guidelines. The next step is to define the objectives of process optimization, ensuring they align with both business goals and regulatory compliance. Potential solutions should then be evaluated against these objectives and regulatory requirements, with a strong emphasis on risk assessment and mitigation. Pilot testing and phased implementation, coupled with continuous monitoring and feedback loops, are crucial for ensuring that optimized processes remain compliant and effective. Question 19. Which approach would be most appropriate for a small finance bank employee when a long-standing customer, whom they know personally, asks for details about another customer's recent transaction history over a casual phone call? Option A. Politely decline the request, explaining that sharing customer information is against a small finance bank's data privacy policies and Indian banking regulations, and suggest the customer contact the bank through official channels if they have a legitimate inquiry. Option B. Forward the request to a supervisor without verifying the identity of the person making the request through secure means. Option C. Provide a general overview of transaction types without revealing specific details, hoping to satisfy the customer without breaching privacy. Option D. Share the requested transaction details, as the employee knows the customer well and trusts them to have a valid reason for the inquiry. The correct answer is A. Politely decline the request, explaining that sharing customer information is against a small finance bank's data privacy policies and Indian banking regulations, and suggest the customer contact the bank through official channels if they have a legitimate inquiry. Explanation. This scenario presents a professional challenge for a small finance bank employees due to the inherent conflict between customer relationship management and the strict regulatory requirements for data privacy and security. Employees must exercise careful judgment to balance fostering positive customer interactions with their obligation to protect sensitive customer information, as mandated by Indian banking regulations. The correct approach involves prioritizing adherence to a small finance bank's internal data handling policies and relevant Indian banking laws, such as those governed by the Reserve Bank of India, RBI. This approach is professionally sound because it directly upholds the legal and ethical obligations to safeguard customer data. Specifically, it aligns with the principles of data confidentiality and security expected of all financial institutions operating in India. By refusing to share information that could compromise a customer's account security, even when a seemingly legitimate request is made by a known individual, employees demonstrate a commitment to regulatory compliance and customer trust. This proactive stance prevents potential data breaches, identity theft, and subsequent reputational damage to a small finance bank. An incorrect approach that involves sharing the requested information based on a personal relationship or assumption of legitimacy fails to recognize the severity of data security regulations. This would constitute a breach of customer confidentiality, violating principles enshrined in banking laws and potentially leading to penalties for the bank and disciplinary action for the employee. Another incorrect approach, which is to dismiss the request outright without offering any secure alternative or explanation, might damage customer relations and fail to educate the customer on secure practices, though it avoids a direct breach. A third incorrect approach, which is to escalate the request without verifying the requester's identity through established secure channels, risks exposing sensitive information if the escalation process itself is compromised, or if the initial request was part of a social engineering attempt. Professionals should employ a decision-making framework that begins with identifying the core regulatory and ethical principles at play. In this case, data privacy and security are paramount. The next step is to assess the request against these principles and the bank's internal policies. If there is any doubt or potential for violation, the default action should be to protect the data. Professionals should then seek clarification or guidance through established, secure internal channels, rather than making assumptions or acting on incomplete information. Educating customers on secure practices and the bank's policies is also a crucial part of responsible customer service. Question 20. Implementation of a new AI-powered digital lending platform at a small finance bank is underway. Which approach best ensures compliance with the Reserve Bank of India's (RBI) regulatory framework and protects customer interests? Option A. Conduct a comprehensive impact assessment covering operational, technological, financial, legal, and customer-centric risks, and develop mitigation strategies aligned with RBI guidelines for digital lending and data privacy. Option B. Focus the assessment primarily on the platform's speed and efficiency, with a cursory review of data security measures. Option C. Proceed with the launch after a basic technical review, assuming existing general compliance protocols are adequate for new digital product. Option D. Prioritize rapid deployment of the platform to gain a competitive advantage, with a plan to address any compliance issues that may arise post-launch. The correct answer is A. Conduct a comprehensive impact assessment covering operational, technological, financial, legal, and customer-centric risks, and develop mitigation strategies aligned with RBI guidelines for digital lending and data privacy. Explanation. This scenario presents a professional challenge because a small finance bank, like all regulated entities, must balance the imperative of technological advancement with the stringent requirements of regulatory compliance and customer protection. The introduction of a new digital lending platform necessitates a thorough impact assessment to identify potential risks and ensure adherence to the Reserve Bank of India's (RBI) guidelines, particularly those pertaining to digital lending, data privacy, and customer grievance redressal. A failure to conduct a comprehensive assessment could lead to regulatory penalties, reputational damage, and erosion of customer trust. The correct approach involves a systematic and proactive evaluation of the digital lending platform's potential impact across various dimensions, including operational, technological, financial, legal, and customer-centric aspects. This assessment should identify potential risks such as data breaches, algorithmic bias, unfair lending practices, and inadequate grievance mechanisms. By proactively identifying these risks, a small finance bank can implement appropriate mitigation strategies, controls, and compliance measures before the platform is launched. This aligns with the RBI's emphasis on responsible innovation and the need for banks to manage risks associated with new technologies. Specifically, it addresses the RBI's Digital Lending Guidelines, 2022, which mandate robust risk management frameworks and customer protection measures. An incorrect approach would be to proceed with the launch without a formal impact assessment, assuming that existing general compliance measures are sufficient. This overlooks the unique risks introduced by a new digital platform and fails to address specific regulatory requirements for digital lending. Another incorrect approach is to focus solely on the technological benefits and speed of implementation, neglecting the potential for customer harm or regulatory noncompliance. This demonstrates a lack of due diligence and a disregard for the principles of fair treatment and data protection enshrined in RBI regulations. Lastly, conducting a superficial assessment that only addresses obvious technical glitches but ignores broader ethical and regulatory implications, such as data privacy or fair lending practices, is also professionally unacceptable. This approach fails to meet the depth of analysis required by regulators to ensure customer safety and market integrity. Professionals should adopt a structured decision-making process that prioritizes a comprehensive risk-based approach. This involves understanding the specific regulatory landscape, in this case, RBI guidelines for digital lending, identifying all potential stakeholders and their concerns, systematically evaluating the impact of the proposed change across all relevant domains, and developing a clear action plan for risk mitigation and compliance assurance. The process should be iterative, with findings from the impact assessment informing design choices and control mechanisms.